June sees calendar-driven spike in delinquencies, a new report put out by ICE, formerly known as Black Knight, a leading global provider of technology and data. Now, recently we had a historic low of foreclosures, but does the data signal trouble ahead? Are those forecasting a crash possibly correct? The headline also reads foreclosures remain historically low. It's important to understand that foreclosures are a lagging indicator of market conditions, largely due to how lengthy the foreclosure process is in most states. While delinquencies are more of an early indicator or warning on what we should be looking forward to, I'm going to share with you the truth about what this means for you, based on actual data that is happening right now. Delinquencies are simply late payments on your mortgage. It doesn't mean a property is going to be foreclosed or in foreclosure. It is usually recorded at a 30, 60, or 90 days or more of late payments. National delinquency rates jumped 14.5%, 45 basis points, to 3.49%. It's the second highest level in 18 months. According to this chart, it is up 14.5% month over month and 11.7% year over year. Goes on to say Sunday month ends often lead to sharp but typically temporary spikes in delinquent mortgages, as payments made on the last day of a given month are not processed until the following month. What they're saying is that months that end on the weekends do not process payments until the following week, which can lead to misleading reports in delinquencies for that month. If true, we should see this reflected in future reports, where months do not end on the weekends. So is this the only reason why the report shows a spike in delinquencies, or is there other factors to consider? June saw a 19.6% increase in the number of borrowers. A single payment past due, the highest inflow since May 2020, while a 60-day delinquency rose 11.8% to a 5-month high. The 19.6% is a single payment miss. It's not a foreclosure or even necessarily an individual that is struggling to make payments. It is a leading indicator to watch for in the coming reports, to see if this is reflected in increases in multiple months. Something worth noting, but not enough to draw any conclusions, not without more data. Now, the 60-day delinquency is a more telling story on potential struggles by homeowners, but more context is needed. Though up 5.1% from May, serious delinquencies, loans 90 plus days past due, not in active foreclosure, were still down 8.5% year over year, 10.1% below pre-pandemic levels. This is down 5.1% from May, but they are referencing those not in active foreclosure, and down 8.5% year over year. 90 plus days is when things get a little bit more serious. This is where the foreclosure process officially starts. It does vary from state to state, so be sure to talk to a professional in your area that is familiar with the foreclosure process to get more details around timelines. Foreclosure starts declined 6.2% in June, pushing active foreclosures inventory to its lowest point since the end of COVID-era moratoriums, now 34% below pre-pandemic levels. 5.3 foreclosure sales were completed nationally in June, representing a 4.9% month-over-month decrease, to the lowest level since February 2022, still well below pre-pandemic norms. Just a reminder, during COVID, people were allowed to do a forbearance, which is the option to temporarily stop payment on their mortgage. It doesn't forgive the amount owed, it just defers it. With it being the lowest points at 34%, below pre-pandemic levels, in the face of heightened mortgage delinquencies, yet we have reduced foreclosure starts and still considered historic lows of actual active foreclosures. So are we safe? Just remember, active foreclosures is a lagging indicator. By the time we hit the point of active increased levels of foreclosures, we likely already been in months to years of trouble. Prepayments eased 7.6% from May, breaking a 6-month streak of increasing prepayment activity as we near the typical seasonal peak of home sales and affordability. And the rate constraints persist. The rate indicates the proportion of mortgage loans that are paid off early each month. Early payoff can happen for various reasons, such as homeowners refinancing their loans, selling their homes, or making extra payments to pay off the mortgage faster. Reduced activity here could be a signal that borrowers are having less financial flexibility. Higher interest rates, increased taxes, utilities, and other costs like insurance and everyday expenses will create this burden. Fannie Mae wrote an article which helps demonstrate some of these major concerns for homeowners. I'm not going to go over this article in depth right now, but it gives a great visual on some of these concerns that exist for many of us right now. The blue highlights the amount of increased homeowners having reported from moderate to significant costs. These numbers are pretty high, and especially when stacked. The percentage of consumers reporting these increased expenses are rather telling as well. 99%, 96%, 95%, 84%, and 84%. The HOA condo fees and flood insurance affects a much smaller pool of homeowners, so these are lower numbers. There's a lot of information and data here. Maybe I'll cover that in more detail on another video, but for now, I'll leave the link in the description if you want to take a look for yourself. Now, if you feel like these costs are impacting you right now, leave a comment below. I'm really interested to see how others out there are feeling about these increased expenses. Because of affordability, we may see some signs of distress happen in the near future, something I don't hear enough people talking about, and it deeply concerns me. However, there does not seem to be any indication that we are seeing a future foreclosure crisis happening based on the current data. Yeah, I do believe we need to pay close attention to things in the coming months. Here's one important factor to consider on reasons we may not see a foreclosure crisis happen anytime soon, at least not here in the US. In the US, we have fixed rate mortgages, and more commonly, a long-term, such as a 30-year fixed rate. In an article by the St. Louis Fed, about 40% of US households have mortgages, of which 92% have fixed rates, and the remaining 8% have adjustable rates. Once locked into that fixed rate, increased payments, minus taxes and insurance, of course, is no longer an issue for the life of the loan, lessening the burden homeowners with this type of loan have. We learned that lesson from the 2008 Great Financial Crisis versus more risky loans such as adjustable rate mortgages or ARMs. Countries like Canada are facing some really serious struggles with this because they don't have the same benefits of having the longer-term fixed rate options like we do here, forcing them to deal with significant rate increases during this period of time. Fixed rate mortgages dominate the market here in the US, making this less risky for homeowners. A huge benefit to being a US citizen right now. Some will try to make a connection between what is happening now to the recession of 2008. There are so many differences between this market and 2008. Here's an article from Duke University about predatory and subprime lending that can give you some insight on the type of financing that played a big part in the 2008 crisis. In the run-up to 2008 crisis, however, many ARMs took on characteristics that heightened risk for borrowers. Approximately 80% of U.S. subprime mortgages issued on those years were adjustable rate mortgages. It lists the various types of financing options that existed, many of which were abused and set up unsuspecting buyers and new homeowners for failure. Loan products including balloon payments, prepayment penalties, ninja loans, no income, no jobs, no assets, no down payment options, interest-only option mortgage, subprime, and teaser rates. This is just to name a few. I'll leave a link in the description if you want to take a closer look at this article. Another reason I don't believe we are facing a foreclosure crisis or a crash in the near future, Redfin put out this article in June. Nearly everyone with a mortgage has an interest rate below 6%, prompting many to stay put. Here's a full breakdown of where today's homeowners fall on the mortgage rate spectrum. Below 6%, 91.8%. Below 5%, 82.4%. Below 4%, 62%. And below 3%, 23.5%. With the number of homeowners that have historically low interest rates, most that are fixed rates, they are in a very good position to sit tight. This is not to say some will not be faced with life circumstances that will force them to sell at some point. But a global foreclosure crisis is not likely outside of some major disruption with something like job layoffs. Now, when you consider these along with the amount of equity buildup that has happened over the last several years, the stricter regulations put in place as a result of the lessons learned from 2000 crisis, foreclosure and crash seems less likely. Now, we do need to keep an eye on other signals, including credit card debt, credit card delinquencies, unemployment, and inflation numbers, which could be leading indicators to future problems. Right now, I don't know if there's enough to be concerned about, but definitely something to watch out for, especially in our local market. Another example of where foreclosure stands on a national level. Attom put out this article, July 11, 2024. Attom, a leading curator of land, property, and real estate data. today released its mid-year 2024 U.S. foreclosure market report, which shows there were a total of 177,431 U.S. properties with foreclosure filings, default notices, scheduled auctions, or bank repossessions in the first 6 months of 2024. That figure is down 4.4% from the same time period a year ago, but up 78% from the same time period 2 years ago. In contrast to the first half of 2023, foreclosure activity across the United States experienced a decline in the first half of 2024. In addition, U.S. foreclosure starts decreased by 3% in the first 6 months of 2024. These shifts could suggest potential stabilization in the housing market. However, monitoring these evolving patterns remains crucial to understanding the full spectrum of the real estate sector. Here's something that hits close to home, quite literally. New Jersey, Illinois, and Florida post highest state foreclosure rates. So let's take a look at Illinois, where I live, as an example. Our market is still very tight, inventory is low, median prices are up, months supply still shows a strong seller's market. Looking at our local multiple listing service here in the northern Illinois, which includes the southwest suburbs of Chicago, where most of my business is focused, you can see for the month of June 2024, this is the lowest level of homes that sold as a foreclosure or short sale going all the way back to 2008. The report for lender mediated sales for the area is 1.8% of the total sales in June, down from 2.1% in 2023 and down from 4.4% in 2019, which is closer to representing the amount of sales in a healthy or more balanced market. Our area is clearly not seeing any increased levels of foreclosure activity at this time, even though there are numerous articles stating Illinois is one of the states with the highest rates of foreclosures. This is why you have to be careful with headlines and get the real data, both local and national, to get a more clear picture. When you hear news of headlines that foreclosures are up 100%, that may seem pretty drastic, but put that in perspective. When distressed sales are at historic lows, 100% isn't much. For example, 186 homes sold in my market as a foreclosure, a 100% increase would be 372 homes. That would still be 40% less than homes sold in foreclosure than in 2019, which is considered a more balanced and healthier market. Now, if you compare that to the peak of foreclosure sales back, let's say 2013, as we came out of the Great Recession with 4,571 homes sold in foreclosure, that would be over 1,100% increase in foreclosure sales that year. Just something to think about when headlines use percentages as their hook. We definitely have challenges to overcome in the next few years. I don't believe a 2008-like crash is going to be one of them. Of course, unless Elon's robots come for our jobs. But that's a different conversation for a different day. If you would like to get a hold of me, all my contact information is in the description below. Don't forget to subscribe and like. See you in the next video.